frankly, if I was an investor, and I do invest a lot, I would always look at a long-term view. Never get tempted by the short-term ups and downs in the market, because when you're investing in stock markets is a long-term story, and you have to stay invested. I think the market reaction over the last 2 days has been exaggerated significantly. If you look at our economy, you have to look at the economy, not look at market. Markets will go up and down, but you have to look at economy, because markets will ultimately follow what the economy is doing. And in my opinion, the Indian economy is strong. It's very robust at this point of time. The tariff war is going to hurt us less than it's going to hurt our competitors. We have to look at things not in absolute terms, but in relative terms. So, first of all, if you look at what is exports. Exports today is about 22 or 23% of our GDP. And then within that, exports to the US are about 17% of our total exports. So if we look at that picture and work out the arithmetic, by my reckoning, the impact on GDP should be about around 40 odd basis points. Not a very material number. Then we come to the benefits that come out of this. The first is the sharp fall in oil prices. You know, I've always said in many interviews that for us in India, the single or one of the most important criteria is oil, because we are such a large importer of oil. And when oil prices come down, it's a big benefit to us, whether it's in terms of current account deficit, fiscal deficit, GDP growth, and inflation, and so on and so forth. So with oil prices having come down so much because of the global uncertainty, we are clearly a beneficiary. And the second is the liquidity that, and first of all, let me first compliment RBI. I think RBI has done a fantastic job in the last 4 or 5 years, ever since we started COVID, to make sure that we did not get the kind of tearaway inflation that the Western world saw. And now we are seeing RBI easing, RBI infusing liquidity in the system. My expectation is that there is a credit policy tomorrow. We'll probably see a rate cut tomorrow. So liquidity, more liquidity will again enhance the GDP numbers by about 10 odd basis points. So net, in my view, the impact on GDP will be not more than 25 to 30 basis points, which is not a material number at all. And now if we are to compare ourselves with China, with Vietnam, with Bangladesh, which are some of the countries which compete with us for exports, we are so much better off. So let's look at it from the perspective that on a relative basis, we are far better off today being in India than being in any of these countries.
Let me also ask you this question. This view that India is better placed than a lot of other Southeast Asian economies is now becoming more prominent in discussions. But I wanted to get a sense. One of the economists who was speaking on our channel a little earlier had said that India might have the largest lifeboat, but they must remember that they're still in the ocean with the rest of the countries. So it's not like we've gone past the choppy waters yet. I mean, yes, we are relatively safe. But do you think those choppy waters have say, a second-order impact at all?
So the primary effect is not going to be very material. Okay. I think a lot of people are worried about the second effect that can come because of tariff. Second effect coming because you see a big slowdown in the US. And if there is a slowdown in the US, what impact it'll have in terms of the IT industry, for example, that job creation will slow down in India. I don't buy that theory. I think, first of all, if there is pressure in the US and US economy starts slowing down, you may, contrary to IT spending slowing down, you may actually possibly see IT spending increasing, because companies want to then take advantage of better technology, better systems in order to cut down on manpower costs. So I don't think you're going to see that material an impact, a second impact, or at least that material, a second impact, in my opinion.
Okay. One of the other arguments was that there is a system that has been set, let's say, over the last 50 years, right? There's a way the world works and the way the world trades. And now you're upending it entirely. You're saying, okay, I don't want to trade with somebody who does X, Y, Z, so I will place reciprocal tariffs on them, and then let's see, and maybe bring back businesses into the US and slightly more insular, inward-looking sort of an approach to global trade. I wanted to get a sense from you, is this even a realistic move? And forget US, for any country.
I think, first of all, there will be a lot of negotiation that will follow. It's not that what has been announced today is Cyclostrand is going to happen like this. Yeah. Some amount of negotiation back and forth will take place. So let's wait for all of that to settle down. I don't think you're going to see trade, such a dramatic change in trade over the over a longer time frame. Let's give it a little time and let things settle down. You see, markets react whenever there is any kind of uncertainty. Yeah. And whenever there is uncertainty, markets sort of tend to fall sharply, which is what you saw the last couple of days where global markets have collapsed a lot. But I think now logical thinking should come into the picture, and you should see the markets getting a little better, unless there is some bad news which keeps coming every day.
Okay. You mentioned a 25 to 30 basis point impact to India GDP, right, because of the current uncertainty. This is also coming at a time when, in general, you're seeing GDP growth sort of taper off a little bit. Does that then add to any concerns?
No. So the way I see it is, if you take the period ahead, I am a lot more bullish and a lot more optimistic about the Indian economy in 25, 2026, because now we've come to a stage where we are less, I mean, inflation has largely been controlled. Even in fact, inflation was even controlled last year and controlled very well. It's just that food inflation spiked, and that caused the headline number to go up. But if you look at core inflation, which is excluding food and excluding fuel, core inflation throughout the year was somewhere in the 3.2, 3.3% range, which is not material. So I think now, with the slight change in stance of RBI, more liquidity being injected, we've seen one rate cut happening a couple of months ago. Probably we'll see another rate cut happening tomorrow. So given all of these facts, I would today be a lot more bullish in terms of government spending happening. I would be a lot more bullish in terms of economic growth next year. So I think for us in India, the only real thing we need to ensure, and full compliments to the government for doing it so long, is to make sure that we are creating enough jobs for all the young people who are passing out from schools and colleges every year. And if we can do that, I honestly believe that there is no reason why the Indian economy should not be on a roll for the next many, many years.
The government is estimating about 6.6, 6.8% roughly growth for FY26. There is also a developed nation target. I mean, yes, it is 22 odd years later, but is that 6.8 enough to drive India?
I think so. I mean, historically, if you look at it, look at what's happening to the rest of the world. Again, let's not look at it in isolation. First of all, a 6% growth is not a bad growth at all. We are comparing the 6.4 or 6.5 of this year, March 25, with the 8.2 or the revised 9.2 we had last year, but that was an exception. Yeah. Anything upwards of 6, 6.5 is a very good number to have. Global economy is growing at what, around 3%, less than 3%. The advanced economies are growing at an even lesser pace. So in that sense, India stands out as a shining star in the global world.
How do you take benefit of this ecosystem? I mean, if you were an advisor to somebody who's probably creating rules, how would you say that, okay, these are areas that we should focus on and ensure that we fill the global supply chain?
Well, I think you have to understand where is the demand going to come from, and what is our capability, what is our strength in terms of being able to meet the demand. So it's going to be very industry specific. So I can't give you a very general comment, but within industries, a lot of things will happen. You take, for example, the IT industry. There is so much of innovation and so many changes that are happening. Almost every month you are seeing something new development on the IT front, whether it's in terms of artificial intelligence or what artificial intelligence will do. So there is so much of scope for growth in services itself, let alone manufacturing. Manufacturing, yes, but even in services. You go to hotels today, any hotel you go to, you see the hotel occupancy rates are booming. The restaurants are all running full. So I mean, on one side you are saying that the economic growth is lower at 6.4 or 6.5%. On the other side, we are seeing that at the ground level, consumption is beginning to pick up again. We did see a slowdown in consumption for some period of time, but that is beginning to pick up. And again, I'm sorry, one last thing, which is that we are a domestic economy. Let's not forget that. We may take advantage of all the challenges which some of the other countries are having in terms of tariffs and improve our exports or increase our exports. But at the end of the day, domestic demand can sustain India. We were not so badly affected during the COVID period, apart from all the great work, and honestly great work that the government and RBI did. I think we also benefited from the fact that we are a domestic economy. And so long as the domestic economy continues to grow, India's growth rate will be there irrespective of what happens.
I want to ask you last couple of questions. The first one is the question about the domestic consumption, right? And yes, it's true that the domestic consumption is what drives India's growth story. We've had a period of a little bit of a slowdown, at least on the urban consumption side. Hopefully that is going to turn around this year. But I wanted to also get your view. Are we missing something on the urban consumption side that maybe, because one view was that the current metrics that we use to measure urban consumption may not completely measure everything. On one end, the data suggests that consumption is slowing. On the other end, you're seeing, large houses being bought, cars being bought. Your luxury cars are showing large number of sales. Yes, smaller cars are not. Anything that you think maybe the data is missing?
So, in my opinion, what happened last year is that, as I said, inflation was very well controlled. But food inflation spiked for a large part of the year, or for some part of the year. Fortunately, that has also come down, and the outlook looks good because we should be getting good monsoons this year. Now, for a lower middle income or a middle income person, more the lower middle income, which is the bulk of where bank deposits come from and consumption comes from, food is the single biggest item of consumption for them. So with food prices being higher than what they were last year by whatever 7-8% at some point of time during the year, out of their total amount of money that they earned, a larger portion went into paying for the food that they were buying, and therefore a lesser amount was available for consumption. I think that will change. I think that was a temporary phenomenon. That will change. I would also expect that deposits in the banking system will also, which has seen a bit of a slowdown for some time, will also start seeing a pickup in the current year.
All right, that was actually going to be my last question. I want to understand bank deposits because it seems that rates as a tool to motivate depositors is not really working.
So that is, you're talking of fixed deposits. When you're talking of bank deposits, you're looking more at the CASA deposits, which is your current accounts and your savings accounts. And that is not so rate dependent. It is not dependent on rates at all. It is dependent on the fact that how much money does the average person have today, and how much money is going to leave in his bank account. So again, it goes back to this item of food, that if food expense is higher, you're spending more on food, you're having lesser amount to put in your bank account. People say that stock market's affected, people started putting money into the stock market, and therefore deposits did not grow. That's a flawed theory. It's a completely flawed theory. Because, for example, if you are buying a share from me, and you pay me money, you will pay me money from your bank account. So it moves from your bank account to my bank account. The total deposits in the banking system don't change. What may change is that retail deposits may become wholesale deposits, which may have a lesser, lendable value. But apart from that, nothing changes. So that's not the explanation.